So like in the recent situation, when the virus appeared on the market and then, the stock market has gone to the downward trend. So so I think then there's another opportunity, like you suggested, in the bond market when it started to rally it up. So then a person like me who only kind of invests in the stock market, whether it's options or stocks in general, then I think, and if there's not an opportunity there because of news like that, then I should probably be looking into more in the bond market where people are putting money into.
Well, two things you could do in a situation like this is if I see some negative news in the markets that may persist, and again, as an investor, I wouldn't be worried that this is going to destroy my portfolio, right? Because this type of thing, if you've seen this before, which we have, we saw it with H1N1 and all those things, is that they tend to be short-lived. The markets freak out, they panic, but it's not going to crash the markets. It's not going to cause the next recession. It's just going to be a shitty time period that you got to weather through. Okay, so how you deal with that, you can either trade it in the short term, or if you're a portfolio, if you are managing your own portfolio, you could say, look, I've already made X amount from these stocks. I may want to take some profits. It is okay and encouraged in a portfolio to take profits when you're ahead, right? Because those stocks, if you just hold them forever and ever and ever, you could see those earnings or that P&L in your portfolio quickly vanish when you hit a recession, all right? So you want to have capital available to take advantage of the recession or any dip, not just to be taken advantage by it. If you're holding it in for the long run, if you're holding those stocks for the long run, again, you could just interpret this as a momentary bump in the road and keep going. Okay, there's nothing wrong with that either. As a trader, right, you want to have one or two things in mind, and that is to sell. Again, the context is I'm trading the S&P because I have the chart here. I want to sell on this news, right? So if I saw this breaking, this would be a very good short opportunity. However, if I got the news later and we're already down here somewhere, remember FOMO. Okay, so I don't want to be selling when everybody's plowing through this trade, because my luck would be the asshole who'd sell at the very, very bottom only to get smacked up by this relief rally, right? So it would wash me out just in time for it to go back in that direction. So what you would want to do in this type of situation is sell it as soon as you hear the news. Okay, we might not have that ability. We might not be in front of the monitor 24/7 to be able to catch that. That's okay. You probably won't. But if you want to get in on that sell, right, what you would do is wait for the market to retrace a little bit into a level. Remember, I'm returning to the concept of levels, and sell there. Okay. Or the third option is you wait for the market to puke itself out and try to buy at a good price. Okay.
But this would be a good time to kind of buy.
Yes, I mean, in my personal opinion, for educational purposes only, please don't sue me. I would consider this a fairly good time to start thinking about the fact that the S&P might be reversing, and there's a couple factors for that, right? If we go to the go Squawk here. All right, we're actually seeing the balance kind of shift to a rather neutral position. We have 8 risk on, 7 risk off, right? 34. This is pretty even. Okay, so also we see, granted, to be fair, this is kind of in the intermediary point of the day where our markets have closed. We're kind of waiting for them to open again. But you see that we're starting to see some resistance here. We're not seeing this huge amount of momentum that we saw earlier. Similarly with bonds, we saw all this momentum here, and then they're kind of tapering, right? So the rate of change, right, is it's increasing, but at a slower rate, at a slower pace. So that kind of tells you that it's running out of gas. So here's the thing: if you did want to buy this dip, it's a very reasonable decision. You just want to set up good risk management. So let's say I just wanted to FOMO into a trade right here and buy, expecting this to appreciate. Well, I understand the fact that there's still some action down here, and my asset could and the S&P could comfortably trade down here, and still nothing has really changed, right? If it breaks this wick right here, that means we're headed off into this vacuum zone, okay? And so you would just, if you did want to take a trade here, you'd have to be careful to protect yourself, right? And that's where we factor in risk management, okay? So just to there's a tool here that allows you to actually set this trade up, right? So if I put my stop loss, right under this wick here, and maybe I expect, what would be a good profit target? If I was to take this, remember we were discussing levels and the fact that we could cross this vacuum zone. So maybe I might set my profit target right around this here. Okay, so this is saying it's a risk reward level of roughly 2.0. It's technically I teach you guys that 3-to-1 is pretty good, but 2-to-1 is pretty good too. So sometimes you don't always get the perfect trade. So just consider when you're setting up a trade the risk management. Okay, that's more important than understanding the direction of the markets, because once you understand that, it's really about your risk management. So you could be wrong about the direction of the market, and if you had good risk management, you could still make money.
So let's say if you're investing for 5 years or something, right, for long term, do you ever put a stop loss on it or no?
In your portfolio? Sure, of course, because you don't want, if you're investing long term and you just picked a shitty stock, you don't want to hold that forever. But your risk management is a lot looser because you're dealing with a longer time frame.
So I don't know if you have talked about the risk management in the previous class, but are we going to dedicate time on that?
We will be revisiting risk management in every slide we do. In every slide where I talk about, where I discuss technicals, we do. And as we progress with this course, we'll be doing, we'll be revisiting live trades that I have actually made and discussing the risk management and the thought process behind them. So you're absolutely right. We will be discussing risk management more in depth. This is not something that comes overnight, nor do I expect it. And it's something I expose you to, or at least I try to expose you to in every single module.
So just the final question for the night for me, compared to what I was saying earlier. So let's say if I have funds invested in the stock market, and obviously I'm more in the long term, so I'm not going to panic because of the outbreak of the virus. But if I have extra funds sitting, then maybe I can use those funds to kind of put it in the bonds.
Yeah. Well, absolutely. There's a couple different ways you could think of it. If you have extra money to invest at a time like this presents you with one of two options. It presents you a buying opportunity in bond products, whether you trade the futures or the options or the actual products themselves, or it presents a buying opportunity in stocks for the longer term, right? So instead of just to conclude with this, instead of buying this part, right, which is what we'd be doing in your example, if you wanted to buy into bonds. If you know stocks and you're comfortable with stocks, just consider this like buying stocks on a discount, right? So you had this huge shellacking here, which drove the price down. This might be a good dip for you to buy, because remember, when you're in a long-term bull trend, you want to buy on dips. You don't want to buy on the rallies, because then something like this could happen and you'd be sitting underwater in your investment for a long time. So I always consider it a good idea to have some cash handy in your investment account so that you can take advantage of these times when you see them. And again, because you are in the long term in stocks, let's say this thing pukes again. I mean, is this going to be the day that stocks, retrace, that I'm going to see the S&P go down into the 2000 handle again? Probably not. Okay, so if I see another shellacking here, then you can add to your position, again, if you are thinking in the long term. So there's a bunch of ways that you could go about it, and just as an investor, you have to think of what's right for you. I know for a long-term portfolio type of guy, I'd be looking to get long on some of the stocks that maybe were a little high for my taste for quite some time. So I don't know We have all this discussion about the recession. When's it going to happen? When's it going to happen? Nobody really knows. We've been in the longest bull run in history. So I'm not going to be the guy to try to call the top and short and make $1 million when it goes to zero, whatever. I want to be the guy who buys on the dips. Okay. So that's where we're at this point.